Look at the New York Stock Exchange. The massive stone columns and 18th century pedigree project a very specific image: unshakable permanence. Now, cross town to Times Square. The NASDAQ is a curved digital screen bolted to a skyscraper. It projects speed, software, and a digital-first future. These distinct looks represent two entirely different financial architectures. Deciding between them dictates how a company's stock actually behaves once it starts trading. Underneath the branding, the market divides into two operational philosophies. One system uses human intervention to slow down chaos and maintain stability. The other relies on algorithms to guarantee instant, frictionless speed. We are going to open up the hoods of both machines. By looking at how these two exchanges process money and evaluate businesses, we can map exactly which venue matches specific corporate profiles and trading strategies. Whether you are a founder preparing to take your company public or a retail investor clicking buy on a single share, understanding this market microstructure is how you accurately measure your risk. For a company, the difference between the two exchanges starts long before a trade is ever made. It begins with the initial listing standards, which act as financial filters. The NYSE demands a proven track record. To get listed, a company generally needs to show at least $10 million in pre-tax income over the last 3 years and maintain a global market capitalization of $200 million. By mandating positive income, the NYSE excludes high-growth startups that are still burning through cash. This standard ensures every company on the exchange has already transitioned to a proven, profit-generating business model. NASDAQ takes a different approach. Their standards allow companies to list based on strong revenue growth and equity, even if they haven't achieved profitability. This is why capital-intensive tech firms, which reinvest every dollar into expansion, gravitate here. Neither exchange lets just anyone in. Both share a baseline requirement to ensure a liquid market: a minimum stock price of $4 and at least 400 round lot shareholders. A round lot means owning 100 shares. This rule prevents a tightly held private company from going public while keeping all the stock among a few founders. It forces them to disperse ownership, ensuring there are enough shares floating around for the public to trade. The listing venue you choose acts as an immediate risk profile filter. An NYSE listing signals historical blue-chip stability. A NASDAQ listing signals high growth potential, which naturally carries a higher inherent risk. When you hear stock exchange, you probably picture hundreds of people in colorful jackets waving paper slips. For decades, that physical auction defined the NYSE. That floor has since shrunk. Today, the NYSE operates on a hybrid system, merging the physical floor with high-speed electronic routing. The core of this hybrid model is the designated market maker, or DMM. These are highly capitalized professionals stationed on the floor who oversee specific stocks. Unlike a pure computer network, DMMs have active obligations. When a stock experiences a sudden shock and everyone is selling, DMMs are required by the exchange to step in with their own capital to buy. They absorb the panic and maintain an orderly price. This chart compares the quoted spreads across different exchanges. Because DMMs actively manage the order book, the NYSE produces the narrowest quoted spreads in the market, averaging 47.4 basis points. That reduces the cost of every transaction for the investor. There is a trade-off. Routing an order through this hybrid system sacrifices absolute speed. And as the physical floor has emptied out, the old advantages of traders building reputations and cooperating face-to-face have faded. NASDAQ avoids the human element. It operates as a purely electronic, decentralized dealer network. There is no central floor and no human referee. Buy and sell orders are instantly matched by algorithms in fractions of a millisecond. For high-frequency trading firms and quantitative funds, this architecture is ideal. Their business models rely on executing thousands of trades a second, and NASDAQ provides the frictionless runway they need. The danger of a purely electronic model appears during a crisis. Without human market makers obligated to step in, algorithms can pull their liquidity from a plunging market. When the computers step back, prices drop violently. The underlying trading architecture forces a stark choice. The NYSE intervenes to protect price stability during chaos, while NASDAQ guarantees frictionless speed at the cost of volatility. When we plot these mechanical differences against corporate and investor goals, we get a clear map of who belongs where based on their specific priorities. Take a retail investor building a retirement portfolio, seeking reliable dividends and a buffer against wild market swings. That aligns with the NYSE. You prioritize tighter bid-ask spreads and structural stability over the daily turbulence of newer sectors. Consider a founder running a scaling software company. You aren't paying dividends. You're plowing revenue back into research to capture market share. You belong on NASDAQ. You accept a volatile microstructure in exchange for the capital access of the tech exchange, matching your aggressive growth. Finally, there is the active day trader or the institutional algorithm, fighting to capture micro-fluctuations in the market. These participants build dual strategies, optimizing for pure routing speed on NASDAQ to beat competitors, while leveraging the DMM mechanics on the NYSE to capture price improvement. Neither exchange is objectively superior. The correct choice depends entirely on whether your primary goal is preserving legacy and stability or accelerating capital and speed.